All right, folks, time to take a look at some questions from Chapter 9 in ACC 220. Okay, so this is all about variances. So, first thing I can tell you is if you want to watch this, you're either going to need another screen probably to put this document up or print it out. Okay, because otherwise it's going to make you crazy to try to keep up with this. Okay, because you'd have to keep referring back to this up here at the top. So the bottom line is this company manufactures one product, and it says they have some variable manufacturing overhead, and it's applied to production based on direct labor hours. Okay, and they give you the standard costs here. This is what they plan on things costing. The company also established the following formula for selling expenses. They said we have a fixed expense of $200,000 per month, sales and commission of $100,000 per month. There's a variable part of their selling as well per unit, $12 per unit, and we have some shipping expense variable. So we have this planning budget says we're going to produce and sell 25,000 units. However, during March, the company actually produced and sold 30,000 units, and then they gave us a bunch of costs here. And so the question is, did we do a good job with our costs? That's really what this is all about. So these problems are going to take you through looking at what you planned on, what you planned on using, what you planned on making, and what actually happened, and also the cost in doing that, okay? So let's take a look at some of these. All right, the first thing they ask about were the raw materials, okay? So the raw materials, okay, notice here, they said you do a comparison. You take the actual quantity that you used right here, right? And then the actual price, and they paid $1,200,000 for it. Now you take the actual input times the standard price, and what would that be? $1,280,000. So what they're comparing here is, notice that they actually got this stuff 50 cents a pound cheaper. So they actually saved 50 cents a pound. So from a materials price variance, the price that they got was good. So they had an $80,000 favorable variance for the price of the goods, okay? Now, the standard quantity allowed, so price-wise they were good, but the standard quantity allowed was only supposed to be 150,000 pounds at $8 per pound, and that wound up being an $80,000 unfavorable variance. So ironically here, they bought the materials cheaper, but they used more materials, okay? So you might be happy with your purchasing agent that purchased the materials, but you're not going to be too happy with the person in charge of operations say, why? They used 10,000 pounds more. That sounds like a lot of pounds. And how they got those numbers, notice here, on their 30,000 units, they're supposed to use 5 pounds per unit for 150,000 pounds. And you get that from that information up above. Okay, I don't want to scroll up there to make you crazy. Okay, all right. There's another way to do this, kind of a shortcut method that you could use here. Personally speaking, if it was me, you see how this is set up? When you have actual, and then you have actual times the standard, and you swap these two around over here, I think this is the best way to do it, because this way you can actually see the numbers. Now, I'm not saying you can't do it the other way. If you want to, there's no problem with that. But what I'm suggesting to you is that if you want to make sure you get it right, if you write it down like this, it's pretty obvious. If you look here, when you hold the quantity the same, notice in column 1 and 2, we're holding the quantity the same, but we're changing price. That means we're looking for a price variance. Look between columns 2 and 3. When we hold the price the same, we're looking for the quantity variance. See, to me, that makes it pretty obvious. Again, if you want to use this other method, that's fine as well. I recommend the one before. Okay. So now, the materials quantity variance, that $80,000 we just saw, that was unfavorable, and the materials price variance, 85,000. How did they get 85,000? Oh, because of what they purchased. Okay. They purchased 170,000 pounds. So notice here, if you take a look here, the difference here is between the pricing, right? So that's going to give us this price variance right here. It's 85,000. Okay. Notice over here to the right, we're going to wind up getting the materials variance, okay, of 80,000 unfavorable. So they actually bought more than they wound up using here. Okay. So again, breaks it down to these different things. Okay. And again, if you choose, by all means, if you want to do it like this, it's not a problem. It's not a problem. Notice here the material price variance is based upon what was purchased. If I'm going to scroll up here, I hope I don't make you dizzy. But if you go up here, notice on this one, this was what we actually used. Okay. The second one was what we purchased. Those are two different things. Got to pay attention to that. Okay. So again, you know, which way you like to do it. I like to put the 3 columns there. If you do that, you almost can't go wrong. All right. Now for direct labor, they were supposed to pay folks $15 an hour. Well, the actual rate, what they were supposed to pay them $14 an hour. So notice here, they're supposed to be paying $14 an hour, and somehow they wound up paying 15. I guess they were short people or something, right? And so you take, you take the actual input of hours times the actual rate, and this is what they actually spent. You compare that to the actual hours of input at the standard rate. That SR stands for standard rate. They were supposed to use 770,000. So from a labor rate variance, basically this is like a labor price variance, they spent 55,000 too much. That's pretty simple. Why? 55,000 hours at $15 an hour instead of 14. That ain't good. You know, now you got to look into why that happened. Now, the standard hours allowed was 60,000 hours times $14 an hour for 840,000. So the labor efficiency, so we paid more per hour. We paid more per hour, but used less hours. Aha. So we paid a little bit more, but we were more efficient. So the overall spending variance is favorable here. So what you could say, you know, this could be one of those cases where, well, you know, we got really good people, so we're allowed 60,000 hours. We pay them a little more, and we actually come out ahead of things. Do you know what I mean? So the bottom line is we used less hours, but we paid more dollars per hour. In the end, it worked out for us. We still saved money. Okay? Again, you can compute these variances like this. Would not be what I recommend, but you could take a, by the way, this is actual hours, and this right here, this S, this is the standard. Whenever you see S is standard, standard rate, standard hours, and A is actual rate, actual hours, okay? Standard rate, actual hours, okay? All right? All right, the next we're going to take a look at variable overhead cost, okay? Same kind of situation here. So we had the actual hours of input. We had 55,000 hours, and there was our overhead divided by the 55,000 hours, comes out to $5.10 an hour. So we wound up, that's what we spend on overhead. Now, what were we supposed to spend on overhead? You take your actual hours times $5 per hour is how they had it calculated. That's what they believed it should be, right? That comes to $275. So from a rate perspective, from a cost perspective, again, unfavorable. However, when you look over here on the right-hand side, well, we were actually allowed 60,000 hours at $5 an hour. So we were allowed 300. So the favorable is 25,000. So again, look what happened here. We spent a little more per hour in overhead than we thought we would. But because we used less hours, we actually, again, have a favorable, overall favorable variance here. So this overhead cost, it's separated into two parts. What was the rate and what was the efficiency? The rate, not so good. The efficiency, very good, and so we came out to the plus. By the way, that's pretty important to know. You know, like the question is, if you use too much money on payroll, why? Did you use too much money on payroll because you paid your people too much? Or, you know, you had to run overtime? Or because you made more sales? Those are decidedly different things. Okay? Again, if you want, by all means, for those of you whippersnappers out there that don't need, you know, maybe I need that because I'm an old man, but there's another way to do it right here. Both work out fine. Up to you. Okay? Now, the last item here is they want to do a flexible budget. Okay? So they said, well, we got 30,000 units sold. Our advertising is $200,000. Our salaries, remember there was the fixed piece, the $100,000 was fixed. And then $12 times 30,000 units. So that's where they got this number right here. And then shipping expenses were $3 per unit. That was all variable. There's your total. Okay? All right? 13, 14, and 15, now that we're taking this information and putting it together and we're comparing the two. So, here's our flexible budget. Here's our actual budget, our actual results. Here's our flexible budget. And when we take those and we put them all together, we'll notice that here, for advertising, we came up $10,000 unfavorable because we wound up spending $210 and we're supposed to be at $200,000. Now, for our salaries and commission, we were supposed to spend $460, but we only spent $455, so that's $5,000 favorable. By the way, if you're ever trying to figure out if something favorable or not, pretend it's your money. That's the easy way to do it. If you're like, wow, we spent $5,000 less on payroll, and that $5,000 is your money, you're happy. If you said we spent $10,000 more on advertising, and that was your money, you're not going to be happy. To me, that's the easiest way. Pretend it's your money. Would it make you happy or not? Now, the shipping expenses were supposed to be $90, and we spent $115. So if you thought you're the boss. You thought your shipping costs were supposed to be $90,000, and your shipping cost came in at $115,000. Are you going to be pleased? The only way you would be pleased is if you sold more stuff. If you didn't sell more stuff, you would not be happy. So there you go, $25,000 unfavorable. Okay? All right, folks, that's it for the foundational 15. These are similar to all the kinds of questions you'll see in your homework. I hope they help you out. If you have any questions, please feel free to get in touch. Talk to you soon. Bye-bye.